Welcome to the deep dive. Today, we're really focusing in on aggressive index investing.
Mhm.
We're strapping in for a deep dive into factor strategies, specifically momentum and alpha, using all that great research you send over.
That's right.
Our mission is to figure out the mechanics behind some, well, truly astonishing returns and understand what the real cost is in terms of risk.
Exactly. We're moving beyond what you might call plain vanilla market cap investing.
Right.
We're looking at index funds that are, custom built for an aggressive investor, someone who is looking for massive outperformance.
Okay.
But we should be really clear right up front. The performance data we're about to go through, especially for some of the newer indices, it's heavily derived from back-tested historical models.
So it's theoretical past performance.
In many cases, yes. And that outperformance always requires volatility. That is the core trade-off we're going to be talking about today.
And the performance is really where we have to start because some of these numbers are frankly a little shocking.
They are.
Let's just compare the baseline, the Nifty 50 everyone knows, with one of the stars of this show, the Nifty 500 Momentum 50 Index.
It's the perfect place to start. It really illustrates what happens when you systematically bet on recent winners.
Okay, so what are the numbers?
Over the last 5 years, the standard Nifty 50 delivered a very respectable 18.94% yearly return. That's solid growth by any measure.
Solid. But the Nifty 500 Momentum 50, it delivered a stunning 35.77% compound annual growth rate.
Over the exact same period.
We're talking about an annual difference of almost 17 percentage points. It's huge.
And if you put that into actual money, the difference in wealth creation is startling.
Yeah, let's do that. A 10 lakh investment 5 years ago in the Nifty 50.
Gives you a 14 lakh gain. Not bad.
But that same 10 lakh in the Momentum Index?
Your gain is roughly 34 lakh.
Wow.
It's more than double the return, just from systematically tilting towards stocks that are already moving fast.
So how does the M50, that's the Momentum 50, how does it actually do this? What are the core mechanics?
The thesis is actually elegantly simple. What has worked recently is likely to keep working for a short time longer.
The trend is your friend.
Exactly. The index is completely rule-based. It identifies the top 50 stocks from the Nifty 500 based purely on their price momentum over the last 6 to 12 months. It's just looking for performance trends.
Which sounds completely different from the Nifty 50, which is just weighted by company size, by market cap.
It is.
Does that momentum-based selection dramatically change what's actually in the fund?
Oh, absolutely. Especially when you look at sector allocation. The Nifty 50 is dominated by financial services, usually around 32%.
Right.
In contrast, the Nifty 500 Momentum 50, because it's driven by recent winners, has a massive allocation to capital goods. It's sitting at 31.2%.
That's a completely different bet on the economy.
It shows you that momentum isn't just finding slightly better versions of what's already big. It's identifying entirely different industry pockets that are hot right now.
And it spotlights some of those specific high flyers like Trent Limited, Bajaj Auto, Adani Ports, companies riding these big momentum waves.
Mm-hmm.
Okay, but now we have to get into the necessary pain. That level of return has to come with higher risk. Let's talk volatility.
Yes. In the investment world, we measure this with beta. The Nifty 50 is our benchmark, so its beta is always 1.
Okay.
So if an index has a beta of 1.28, it theoretically moves 28% more than the Nifty 50, up or down.
And on a one-year basis, the M50 does exactly that. It's got that high beta of 1.28.
It does.
So if a market correction hits, you're pretty much guaranteed a rougher ride than the passive investor.
That's the short-term reality you must sign up for.
Yeah.
But, and this is really interesting, there's a counter-narrative in the long-term data.
Oh.
While that short-term beta is high, over a multi-year horizon, say 5 years, or even since the index's back-tested inception over 20 years ago, that volatility actually decreases relative to the Nifty 50.
Wait, what? So the worst of the pain is short-lived.
Precisely. Over the longest period, the beta actually drops to 0.88.
So it's less volatile.
It suggests that while the M50 is highly volatile during these short bursts of market chaos, over the very long term, it surprisingly exhibits less volatility than the Nifty 50. It's a compelling argument for extreme patience.
That completely reframes the risk profile. Okay, before we get to alpha strategies, let's quickly touch on the rest of the momentum family. Are they all this good?
There are 2 other major players to look at. First, there's the Nifty 200 Momentum 30, or M30. It selects 30 stocks from the Nifty 200 universe.
And the returns?
Its 5-year returns were 30.53%. Excellent, but a little behind the M50's 35.77%.
And then there's a real powerhouse, The nifty mid-cap 150 momentum 50.
Yes, because it's pulling from that more agile mid-cap universe stocks ranked 100 to 1 to 250. It showed the highest 5-year CAGR of the three. It nearly hit 40%,
Almost 40%.
39.93% to be exact.
This brings us to a really crucial point for you, the investor. When you're thinking about diversification, what about the overlap?
A very important question.
If you buy both the M50 and the M30, are you just buying the same stocks twice?
Largely, yes. The source material is clear on this. The Nifty 500 M50 and the Nifty 200 M30 have a massive overlap in their top holdings.
The same names, like Trent and Bajaj Auto.
Exactly. They're in both. So an aggressive investor should probably choose one or the other, not both.
Right. But if you do want to diversify within momentum, the nifty mid-cap 150 M50 is a viable second choice.
Because its mid-cap focus means very little overlap with the others.
Correct.
Okay, so now let's explore alpha.
Yes, alpha indices. They're often confused with momentum because they also rely on recent price movement. They quantify it as an alpha score.
But the difference is key.
The structural difference in how they weight the stocks is crucial.
This is the real insight here. The selection process is similar, but the weighting is fundamentally different.
Yes. So your traditional momentum indices, like the M50, allocate weight based on the momentum score and their free float market cap.
Right, which is basically the number of shares available to trade, so it's biased towards bigger companies. It's biased. The index automatically gives more weight to the largest, most established companies that are also doing well.
So momentum indices prioritize winners who are also big.
Correct. But alpha indices, they allocate weight solely based on the alpha score, purely on performance.
Ah, so they're not structurally biased towards large caps.
Exactly. This allows smaller, faster-moving, high-momentum stocks, the hidden gems, you could say, to take a much larger weight than their size would normally allow.
And we can actually see that difference in the allocation data.
We can.
The Nifty 200 Alpha 30, as of June 2024, had a mid-cap allocation of 5.38%. The similar Nifty 200 Momentum 30
Because of that market cap weighting.
had only 0.74%.
And this is why, in theory, alpha indices can generate marginally higher returns. They're less constrained by size. They are pure performance bets.
But I imagine there's a trade-off.
There always is. That freedom also means momentum indices might offer better downside protection simply because they have more exposure to those big, stable, large-cap companies.
And there's another tactical difference, right? The rebalancing frequency, how quickly they can dump a loser.
A very important point. Most momentum indices rebalance semi-annually, every 6 months. Alpha indices often do it quarterly.
And we saw a perfect real-world example of this with the stock outcome.
Yes, outcome. It was added to both index types in late 2023. It was riding huge momentum.
But it lost steam really fast.
It did. And the Nifty 200 Alpha 30, with its faster quarterly rebalancing, was able to shed that stock and exit in March 2024.
But the momentum index.
The semi-annual momentum index was stuck holding outcome for the full 6 months. This shows how that faster rebalancing in some alpha strategies can be a crucial tool for protecting gains.
So if we look at the performance summary over that back-tested 7-year period, the sheer power of all these is undeniable. All 11 alpha and momentum indices beat the Nifty 500.
And the leaders were those pure factor plays, Nifty Alpha 50, Nifty 500 M50, and the Mid-Cap 150 M50. All of them consistently delivered over 25% returns.
It's worth noting that the multi-factor strategies generally lagged a bit on raw returns.
They did.
But returns aren't the whole story. If we look at risk-adjusted returns, the Sharpe ratio, the picture gets a bit more nuanced.
It absolutely does. While the pure momentum indices had the highest raw returns, they also had the highest standard deviation. They were the most volatile.
So the bumpiest ride.
The bumpiest ride. But when you factor in that risk, the multi-factor Nifty Small Cap 250 Momentum Quality 30 actually delivered the best risk-adjusted returns.
That's a key takeaway. Managing risk can be more profitable than just chasing the highest number. And there was a fantastic finding on downside protection.
Yes, the Nifty 200 Alpha 30 really stood out here. It offered superior downside protection. It fell less than the Nifty 500 in 8 out of 12 recorded negative quarters since 2013.
That is a huge metric for an aggressive strategy. You get the outperformance and growth, and it protects you better in drawdowns.
It's a powerful combination.
That idea of downside protection leads us perfectly to the final strategy we need to cover, the quality factor. This is for the aggressive investor who wants slightly more managed risk.
This is a strategy built on finding strength and resilience, not just pure speed. Take the Nifty Small Cap 250 Quality 50.
Okay.
It selects companies from the small cap universe based on fundamental quality criteria. It's designed to screen out the risky firms.
And those criteria are very specific. Things like high return on equity, low debt to equity.
Right, low financial leverage, and crucially, high earnings visibility.
Explain earnings visibility. That sounds like a bit of a vague term.
It's critical. It's not just an estimate of future growth. It specifically looks for consistency and stability in earnings. It's measured by criteria that indicate reliable, high-confidence revenue streams.
Like a strong contract pipeline or market dominance.
Exactly. It gives the investor confidence in future earnings.
And this focus on stability pays off.
It does. Since inception, this quality index gave 19.8% yearly returns, which beat the standard small cap 250 index's 16.3%, but the real benefit is that stability.
Lower drawdowns.
The quality index consistently showed much lower falls during market corrections compared to the normal Nifty 250 index. It's the closest thing to growth at a more reasonable price in this hyper-aggressive space.
So we've laid it all out, the huge return potential, the inherent high short-term risk. For any listener who's considering these, what is the essential framework they have to adopt?
I'd say there are three non-negotiables for investing in these kinds of funds.
Okay.
First, your time horizon must be very, very long. We are talking a minimum of 10 to 15 years. You have to have the patience to ride out some severe short-term pain.
Second, I imagine, is capital allocation.
Absolutely. This should only be a smaller, dedicated portion of your overall portfolio. This is money you are comfortable tying up and letting compound, unbothered by the short-term noise.
And the third thing.
The mindset, specifically the mindset regarding turnover. You have to be prepared for a high churn rate.
The stocks are constantly changing.
Constantly. Momentum strategies inherently involve significant stock changes every 6 months. The index is designed to kick out the slow movers and replace them with fresh winners. That's the engine of the returns.
Okay, so if an investor meets that checklist, how accessible are these strategies today?
They're becoming widely available, actually. The Nifty 500 M50 has options from Motilal Oswal, Nippon, and Bandhan.
And the Nifty 200 M30.
That's the most widely accessible. There are 7 different options there. The mid-cap 150 M50 is available from Tata, Kotak, and Edelweiss.
And what about that pure performance play, the Nifty 200 Alpha 30?
That one currently has options available only through Mirai, in the form of an ETF or a fund-of-fund.
So, to wrap up,
The overarching takeaway from all this data is really clear. These factor indices, based on momentum and alpha, are powerful tools. They consistently outperform passive, market cap-driven indices over long periods. But generating that alpha demands a steep price, significantly higher short-term volatility, and a robust long-term investor mindset.
which leaves us with a provocative question for you to mull over. The Nifty 200 Alpha 30 showed better returns and superior downside protection compared to its market cap constrained momentum counterpart. Does this suggest that eliminating that free float market cap constraint and weighting stocks purely by their performance score is a superior structural mechanism for unlocking true risk-adjusted performance and factor investing? What stands out to you in this data?